More pressure coming down on SVB, the parent of Silicon Valley Bank. Founders are now advising companies to withdraw funds from SVB. We are hearing that some venture capital firms, including some of the biggest names in Silicon Valley, are advising their portfolio companies to remove money out of Silicon Valley Bank after we saw SVB announcing this morning that it intended to sell shares in pursuit of more capital. This, of course, really caused the ricochet effect across the rest of the markets, particularly when it comes to US banks. We saw US bank stocks tumbling by the most in just about 3 years after that happened. And we continue to watch really that fallout, SVB falling the most on record as these startup clients are facing what's seen as a cash crunch, really taking steps to shore up capital after being hit by losses on its securities portfolio, as well as funding slowdowns at the VC-backed firms that it banks. Let's get some reaction to this. Banríon Capital Management President and CEO Shana Sissel joins us now from Chicago. Shana, you've been watching all of this play out. What do you make of it? Does it indicate that it's the beginning potentially of further jitters and perhaps dislocations in the market to come?
I think what you're seeing is really a concern about some of the riskier areas of the market. You know, SVB does tend to cater to the higher risk venture capital firms, so that becomes a bigger concern. I'm not sure it's going to impact all of the banks. After the financial crisis, there were the too big to fail rules, and the larger banks in the US in particular don't have a lot of exposure to mortgages, don't have a lot of exposure to higher risk credit. They are required for regulatory reasons to maintain substantial cash balances. So I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk. And so you're kind of going to see that kind of move along to others that are in that space as well, I believe.
This is really going to be a test of some of the stronger banks, right, that have proven to be more resilient. Do you like financials going into this potential, new regime that we see as being flagged by the Fed?
No, I don't. And it's interesting because normally you would like financials in a rising rate environment. Their margins get better. The credit conditions tend to get tighter. They can be rewarded more for taking on risk. But you're not necessarily seeing that right now. In fact, the pace and the accelerated pace of the increases in rates is actually not to the benefit of the banks. And so right now, I'm not a huge fan of banks. I think there's definitely some cracks in consumers and consumer debt, and there's some risk there in commercial real estate that I would want to stay away from. So I'm definitely not a buyer of financials right now.
So how do you take advantage of higher rates if you're not buying financials? Where are the opportunities?
Well, in the equity market, you can look at utilities and you can look at dividend payers. Obviously, the best way to take advantage of rising rates is in the fixed income markets, really. That's where you have to look at, how much more are the rates going to go up? How is that going to impact my par value? And am I going to get paid for it? So you can actually get very, very attractive yields in some of the safer or, less risky fixed income products right now. So, for what I'm doing with some of my clients, there's a product I'm using. It's an ETF, THY, that can take advantage of some of the higher yields as yields go up and take advantage of those markets while having some risk management associated with it. There's also floating rate, which can be attractive at times when rates are going up. Depending on the fund, of course, the manager selection becomes very important because you want to know, what kind of floating rate product that they're focusing on.
Headed into the jobs report tomorrow, what should we be watching out for?
I actually think the stronger the jobs report, the bigger the sell-off. We have a lot of cracks in economic conditions going on right now. You're seeing, stress in the banking markets, but the Fed is talking about being more aggressive and faster in their rate hikes. And a strong labor report, a strong job report would suggest that there's still way too much tightness in the labor markets, which is a problem. And so that will only give the Fed more reason to raise 50 basis points. If it's not as strong, I think you could have some relief with everything else going on. The Fed might take pause, despite the fact that earlier this week, you had Chairman Powell, reiterating the fact that they're going to be more aggressive and higher for longer. But I do think if we see a very strong jobs report, and it does look like that's going to be the case, that's actually bad news for the market. And you will see stocks sell off again. I truly believe that.
Shana Sissel, good to have you with us, Banríon Capital Management President.